Okay, the last one for homework 1 on chapter 4 is E412. E412 gives us some information about Mouse Potato Inc. And it gives you essentially what is a chart of accounts, okay? The reason why I picked this problem is because it deals with, what can be considered a chart of accounts. COA standing for chart of accounts. Remember when we talked about chart of accounts in the class and indicated that, in a business setting, each specific business has a specific set of accounts, right? Because you might have multiple accountants and each of them have their own ideas, right? And they see a transaction and they think, oh, this transaction happens, I should call it this. And another person sees a transaction, the same one, and says, oh, this happened, I should call it that, right? And both of those are okay because everyone's allowed to have their own opinions and own minds. But when we have multiple people working in one business and we want the data to mean something, we have to have some consistency, right? We have to have the people agreeing that, okay, when this transaction happens, every single time we need to use these items, right? These accounts, and record them that way, right? Well, on top of that, in a chart of accounts, a COA in a chart of accounts, it usually has information such as an account number, like 101, and then account name, like let's say cash. And then you might even have a description which gives you information about when you should use that account, right? So that everyone stays consistent. In practice, when we write journal entries, it's often in a computer environment. We actually plug it into accounting software, right? When we plug that information in, we typically use a number, not the actual account name. Typically, we use a number. Now, some software systems do use the account name. Ones that are more user-friendly to like the non-accountant, like QuickBooks, Peachtree, you can use like the account name. But as you get into the more advanced software, you typically are using numbers, right? And in reference, even in business talk, we'll talk using numbers. We'll say, I debited 101, I credited 102 or whatever. Something like that, indicating an actual name, but we refer to it by the number. And the reason why I like this problem is because it does that. It doesn't use a number, it instead uses a letter. But it's the same substitution effect. So I want you guys to experience that, what that might look like in a real life setting, okay? All right, so with that being said, they do the first one for you. Let's read the information real quickly. It says, accrued wages unrecorded and unpaid at year end, $400. And they give you this information. They say you debit code O. O is wage expense, so we put that up here. And you credit P, which is wage payable, because we did not pay them cash. Remember, the information that it says is that it's unrecorded and unpaid, right? So we haven't yet paid them. So that's why we're not crediting cash. But that's our example problem. Let's go on to actual. On B, it says service revenue collected in advance, $600. In this instance, when we're looking through the chart of accounts that we have, the option, right, which one fits best here if we're looking through the chart of accounts? Well, if we collected something, in this instance we collected cash, right, the cash letter code is C. So, they're not paying us with Twinkies or something, they're paying us with cash. So that's what we're going to record. In order to increase cash, we debited it. They tell us that the amount that we get here is 600, so we'll debit cash for 600. The next one, what do we credit? Well, in this instance, we collected the service revenue in advance, so we haven't actually earned it. So we should be scanning the chart of accounts here, looking for unearned revenue. Unearned revenue turns up in letter N, so let's use N, and it's going to be for the same amount here, 600. Okay? Moving on to C. At end of year, interest on notes payable not yet recorded or paid was $220. In this instance, when you're dealing with notes payable, remember the difference between accounts payable and notes payable is that notes payable has some sort of interest component. It's also associated with a borrowing money, as opposed to accounts payable is more associated with vendors. When you, let's say for instance, you're a book manufacturer, you buy paper from your vendor, right, who's giving you paper so that you can create the books and then sell them. And once you do that, your vendor will give you like 30 days to create those books, sell them, and then pay them. That's accounts payable. No interest component associated. But with notes payable, we have an interest component associated. So looking at this, it says at year end we have the notes payable, not yet recorded or paid, $220. Looking at this, we are paying out interest. We're actually not paying it yet, but we're incurring the expense, right? We're not receiving interest. That's the point I'm trying to make, is that we're not receiving interest, we are paying interest. Although it's not yet, we are paying interest. So looking at the account here for debit, if we scroll down the chart of accounts, we see interest expense. Interest expense is what we're incurring. That's letter F. And what are we crediting? We haven't yet paid the interest, so we'll scroll down until we find G. G should be interest payable, and the amount's going to be the same on both sides here. It tells us that it's $220 is what we haven't yet. Okay, so put $220. D says depreciation expense for year 1000. Well, we know if we're recording depreciation expense, we debit depreciation expense, credit accumulated depreciation. So let's find the letters here. If we look at D, D is depreciation expense and B is accumulated depreciation. So we'll put D and B, and the amount that they give us here is 1000. Going on to E. E indicates service revenue earned but not yet collected at year end. So in this instance, we've earned revenue. We haven't received cash yet, so that must indicate that we have accounts receivable. Accounts receivable, if we scroll to the chart of accounts, is letter A. And what have we earned? We've earned revenue. If we scroll to the revenue side, we see service revenue there at K. So we'll put down A as accounts receivable and K as the earned revenue. The amount that they give us, again, is $1,000. So we'll place $1,000 so that debits equal credits 1,000. Next on F. F says balance in supplies account was 400. Supplies on hand at year end is 150. You draw out a T account again real quickly. We have 400. This is supplies. End of the year should be 150, meaning our black box is 250. So we know that the amount here is 250 over here, 250 over here. And then when we use up some supplies, we debit supplies expense and credit our actual supplies that we're using. So the letters that we're looking for are M, supplies expense, and L, supplies. So we debit M, credit L. And then, and I'll erase this so it doesn't get confusing here. The last one here on G. G says adjusted balance at year end in service revenue account was $75,000. Give the journal entry to close this one account at the end of the year. Brings up a topic that I want to discuss briefly, real quickly. When you look at the statement of retained earnings, okay, statement of retained earnings, I'm going to write this over here so we can see. When you look at the statement of retained earnings, the calculation is you start with beginning balance of retained earnings, you add net income, you subtract out dividends, and you get the ending balance of retained earnings, right? That's our formula, that's our calculation, okay? Now this is a calculation, but retained earnings is also an account. Remember, this is a financial statement. This guy right here, that's a financial statement. But retained earnings itself is actually an account. It's an account that you can make a journal entry to. So this account itself is not just a product of this calculation. If we want to change that account, if we want to increase it or decrease it, we have to debit or credit, right? We have to do one or the other. Debit would decrease, credit would increase, right? So if we want to change this account, we've got to actually make a debit or credit to that. When I told you earlier that income statement accounts are temporary, we also call them nominal, temporary or nominal, meaning that at the end of the year, these accounts will go to zero. All the income statement accounts, the revenues and the expenses, they all go to zero at the end of the year, right? But where do they go to? Well, looking at this calculation, if we make those accounts zero, right? Looking at this calculation, you can see that all the income statement accounts, which include revenues and expenses, go to retained earnings. And the other item that goes to retained earnings is dividends, which we won't talk about in this problem, but we will talk about as we do the close process. So net income, which includes revenues and expenses, have to go into retained earnings. And dividends also have to go into retained earnings. These would decrease it, expenses would decrease the retained earnings, and revenue would increase retained earnings, okay? And dividends would decrease. So how do we take them there? Well, let's look at a T account real quickly. With a revenue T account, They give you the balance of $75,000, saying we have $75,000. Why is it a credit? Because remember, the normal side of the account is the side that you increase the account on. For instance, how do you increase revenue? You credit it. Therefore, the normal side, the side that's going to hold the balance, is going to be the side that you increase it on, typically. If it's not, then it's a problem, and it's something as a manager you would want to know why it's on the opposite side of the balance. So typically you can assume that it's going to be on the normal side of the T account, and that would be the credit side with revenue. So we see that revenue has a $75,000 balance. Well, at the end of the year, I just told you, you have to make this zero. How do we make this zero? If it's $75,000 on the credit side, right? How do we make it zero? You debit it. You debit it for $75,000. So that means in our journal entry, at the end of the year, after we prepared all the financial statements, we then have to make a journal entry, which would debit revenue. In this instance, it's $75,000. So that's our journal entry. It's a closing journal entry. Remember, we've been working with adjusting journal entries on the last few problems, right? This is what we call a closing journal entry. So if we're making this zero, where do we put the other side, right? Debits have to equal credits. This other side has to balance. What's the credit? The credit is sending it to retained earnings. The credit is R/E. It is retained earnings. So we credit retained earnings. Notice this would increase retained earnings. We credit retained earnings for $75,000 to close the amount, taking the income to retained earnings, because remember, retained earnings is an account. It's not just a calculation, it's an actual journal entry account. So we have now increased retained earnings. The same can be true for expenses, except the opposite. With an expense, if we had an expense here, let's say we had supplies expense, because we've been using that, okay? And let's say supplies expense was, I don't know, 4, right? Its normal balance is the debit side. Why? Because you increase an expense account with a debit. So how do we make it zero? How do we make this zero? If it's on the debit side, how do we get it to be zero? Well, instead, we have to credit this. At the end of the period, after all the financial statements have been created, you then do closing journal entries, which would credit the expense account to make it be zero. Now it's zero. There's no balance left, right? And let's write that down. Then we would credit supplies expense, and we'll put 4 over here. But what do we debit? Again, net income is made up of revenue and expenses. All of net income has to go to retained earnings. So we would debit our retained earnings to take supplies expense and put it into retained earnings. Notice that a debit to retained earnings decreases it, right? The credit to retained earnings for that revenue increased it. We're taking the revenue and we're putting it into the account retained earnings. Remember what retained earnings is? It's the excess that the company holds on to reinvest or to do whatever with, right? It's the earnings that it retains. So here's how we show net earnings, because remember, net income is revenue minus expenses, right? So essentially combined, this shows you how we take net income and we put it into retained earnings, which is an account. It's not just a calculation. But as a matter for this problem, we weren't actually given information about expenses. So this is just for illustration purposes, right? What we were given information for is the revenue. It tells us the balance at the end of the year for the service revenue account was $75,000. Give the journal entry to close it. When they say close, they're talking about making it zero, right? So the journal entry that we want to do is debit the revenue to make it zero. The service revenue particularly is code K. So we would debit code K. How much? $75,000. That's how much it had. We got to make the whole balance zero. And we credit retained earnings, which is code J, for the same amount. We'll talk about closing dividends, in class or through another exercise, because that information is not given here. But the only other part would be to close dividends to make this zero and close it against retained earnings. But Here should be your information for problem 8412. Please let me know any questions you have.